Eric Balchunas, The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. Dive into the world of Jack Bogle, the unsung hero who transformed the landscape of investing with the creation of Vanguard, a company that focuses on offering low-cost index funds to everyday investors. In this summary of The Bogle Effect by Eric Balchunas, you'll learn about Bogle's innovative approach to democratizing investing with the principles of passive management, mutual ownership, and a relentless focus on minimal fees. Discover the reasons behind Vanguard's market dominance, the continued rarity of its mutual ownership structure, and the impacts of Bogle's ideas on the investing world.
Vanguard success without compromise. John Bogle created Vanguard, a company aimed at providing everyday investors with a good deal. The company's success is due to its embracing of the idea that investors want low-cost index funds. Vanguard offers passive management, with its index funds aiming to match the stock market rather than beating it. Its total stock market index fund was the first to reach $1 trillion in assets. Despite holding a 29% market share, Vanguard only collects 5% of industry revenue. The company's formula involves serving up passive management without big commissions or outside sales staff. Bogle created an investment colossus that is beholden to no one but the investor. Vanguard's mutual ownership. Vanguard's success can be attributed to its mutual ownership structure that lets shareholders decide how to spend the firm's revenue, resulting in lowered fees. Unlike other investment firms that have built-in tensions between managers and investors, Vanguard's mutual ownership model has allowed them to consistently cut fees and provide better returns for investors. Despite its success, mutual ownership remains rare in the industry, with BlackRock and State Street being publicly traded, and Fidelity and Capital Group being privately held partnerships, both with inherent conflicts between managers and investors. Jack Bogle's altruistic vision for Vanguard's mutual ownership came at a cost, but it has proven to be a prime reason for the firm's success over the decades. The Art of Common Sense Investing. The Little Book of Common Sense Investing, published in 2007, is a manifesto for investors. John Bogle, the author, argued that the key to successful investing is to own all the nation's publicly held businesses at a low cost. Bogle dismissed stock picking and market timing as foolish approaches and instead advocated a simple strategy: buy a basket of stocks and move on to other things. Bogle believed that an index fund was a bet on the U.S. economy and that average returns are good enough. The index fund approach is a sound investment strategy that mitigates the risk of outsized losses. The Vanguard of Investment Integrity. The story of Jack Bogle, the founder of Vanguard, and his vision of honest investment companies operating for the benefit of shareholders. Jack Bogle, the founder of Vanguard, was passionate about honest and ethical investment companies that benefited their shareholders. He developed this vision during his senior thesis at Princeton in 1949, where he drew inspiration from a Fortune magazine piece about an investment manager in Boston. Despite the ups and downs of the coming decades, Bogle remained steadfast in his belief in benefiting the shareholders. He maintained his legendary edicts, such as "stay the course" and, in the long run, reality rules. Bogle was a man ahead of his time, especially during the 1980s bull market, where the young traders of Wall Street were fueled by greed and excess. However, Bogle stood apart from the crowd, focusing on cutting down the expense ratios paid by investors. He shared a deep passion for frugality with Benjamin Franklin and watched index funds gain traction after the market crash of 1987. The story of Jack Bogle is one of investment integrity, where his commitment to honest operations and ethical investments for the benefit of shareholders still stands today. Disrupting Wall Street's investing model. Bogle's investment strategy disrupted Wall Street's dominant model of actively managed mutual funds by exposing two critical issues: their lagging returns and excessive fees. The fund industry generates $140 billion in annual fees, with active managers keeping the 1% fee rate locked in, resulting in soaring revenues without correlating expenses. Bogle's approach emphasizes investment in low-cost index funds, which have consistently outperformed active funds. By refusing to pass on savings to clients and merely riding the wave, active managers have surpassed 2 times the size of their portfolios without producing better returns. Bogle long criticized this reality, but with little success. His investing philosophy remains an alternative for investors seeking maximum returns with minimum fees. The rise of ETFs. ETFs are an extension of index mutual funds that offer low fees and intraday trading. While ETFs were introduced in the 1990s, their popularity surged during the global financial crisis of 2008. However, their inventor, Nate Most, originally received negative feedback from Bogle, who believed that intraday trading was ridiculous for index fund investors. Despite Bogle's initial reservations, Vanguard is now the second largest issuer of ETFs, offering them as an option to protect their index mutual funds from short-term traders and taxable capital gains. The tax benefits and versatility of ETFs have made them the Silicon Valley of the investing world. The rise of the Cheapville investors. The book discusses the shift in investor mindset from focusing on past returns to cost ratios, largely due to Bogle's idea of management fees robbing investors of their savings. This has led to the rise of low-cost funds capturing 99% of dollar flows. The trend has also resulted in fee shaming among investors who brag about their low expense ratios and mock those who pay active management fees. The cost migration has even affected retirement plans, with most assets held in 401k plans now in low-fee index funds. This new consumer mindset has led to a fee war and a shift towards low-cost investments. The truth about low-cost index funds and Wall Street. Index funds have disrupted Wall Street's tradition of active management, leading to criticism that they create bubbles and distort markets. However, data shows that indexing has not caused a bubble and that market fluctuations existed long before index funds were introduced. While index funds do occasionally behave foolishly, their flaws are isolated incidents. The rise of index funds has made investing more accessible and transparent for individual investors, but it has also disrupted the traditional wealth creation model of Wall Street, leading to a vested interest in undermining the popularity of index funds. Despite criticisms, the popularity of low-cost index funds continues to grow among investors. The growth and tensions at Vanguard. Vanguard's runaway growth was a double-edged sword for its founder John Bogle. While he welcomed the affirmation, he also saw Vanguard's $3 trillion in assets as appalling. Bogle clashed with the company's push into ETFs, despite maintaining an office at the headquarters. Vanguard employees still revered Bogle, and both he and the company remained committed to low-cost, investor-friendly products, keeping tensions at a low-level bickering. The power of diversification. Investing in a diversified index fund is a straightforward process, but maintaining the investment for the long term can be challenging. The media amplifies market moves, causing anxiety in investors. Barry Ritholtz advises investors to follow the Bogle ethos by creating a diversified portfolio of low-fee index funds and rebalancing it annually. Bogle's innovation was to create an investment that investors would feel comfortable holding for a long time, offering a safe haven from the urge to make active trades. Humans are wired to follow the crowd, which leads to the fear of missing out or a fear of loss. By understanding human psychology and behavioral finance, Bogle's index fund solution has made long-term investing easier and safer.
The Bogle Effect highlights the remarkable legacy of John Bogle and his groundbreaking Vanguard. The company's success in providing low-cost index funds based on passive management and mutual ownership shattered conventional notions of investing and triggered a seismic shift in the industry. Despite Bogle's departure from the company and his wariness of ETFs, Vanguard's commitment to investor-friendly products remains steadfast. Thanks to pioneers like Bogle, investment strategies now place significant emphasis on cost ratios, inciting a fee war and fueling a more consumer-centric market. With an unwavering devotion to his principles, Bogle's innovations continue to resonate, offering invaluable lessons for modern investors.